Hello and welcome to MF Corner. I'm Sonal Bhutra and with me as always is Vinny Motiwala. We are here to answer all your mutual fund related queries.
Motiwala Vinny also would be okay as long as it's not Moti Sonal.
Alright, so today is the day where we answer all our viewers' queries, and for that we have our guest joining us now, Kirtan Shah, founder and CEO at Truvanta Wealth, and Rushabh Desai, who is the founder at Rupee with Rushabh Investment Services, joining us now. Gentlemen, good afternoon. Thank you so much for joining in. Guys, it's a laughter riot in the studio today, so we have to avoid that. But thank you so much for joining in. Let me go across to Kirtan first up, because we have received a lot of queries today. Virat Joshi is writing to us from New Delhi. He wants to know 5 mutual funds to invest in for the long term and is looking to invest 2,000 in each funds. Kirtan, let me start with you first up. Of course, we don't have the goals here, the risk profile as well. So those are certain things we need to consider as well. But notwithstanding all of that, do you have some names where the investor can invest, considering some of the conditions which would be obvious in certain cases?
Sonal, thank you so much for having me on the show. I think, of course, like you rightly said, we don't have anything else except for a one-liner. So it's kind of difficult to be able to tell him what will fit his actual requirement. But putting in some assumptions, let's say the investor has 8-10 years of investment horizon and can actually take the volatility which will come along with investing in probably a mid-cap or a small cap, then I think these are the 4 funds that I would rather recommend that he invests his money equally divided amongst all of these 4 funds. First is the ICICI Value Discovery. Second is the PPFA's Flexi Cap Fund. Third is Edelweiss Mid Cap, and fourth is Nippon Small Cap. Now, the idea behind the 4 funds that I've suggested is pretty simple. They are diversified across market cap, across large, mid, and small. And also they have a very decent diversification across the style that each of these funds follow. So I think this can be a good starter, considering 8-10 years of investment horizon and the investor is okay with volatility.
Okay, thanks for that, Kirtan. But, Rushabh, the same question to you. An afternoon, 5 funds that you would suggest the investor, they want to invest 2,000 rupees in each of these funds. What would it be?
Hi, Vinny. Thanks so much for having me on the show. As Kirtan also mentioned that, the investor has just given one-liner. It's quite difficult to actually, recommend quite precisely. But again, putting an assumption that he has around 10 years of time horizon and has a high risk appetite. So these are the 5 mutual funds in my recommendation list for him. Number 1 is a Parak Parekh Flexi Cap Fund. Second is Invesco India Contra Fund. Third is Motilal Oswal Nifty 500 Momentum 50 Index Fund. The fourth is the Edelweiss Mid Cap Fund, and the fifth is the DSP Small Cap Fund. So this portfolio, helps give a good diversification across different categories, AMCs. It also gives a good blend of different styles and different market capitalization as well. So having a good blend and well-diversified portfolio helps to boost returns, and definitely it also helps in minimizing underperformance risk. So I think, having a bit of active participation and passive participation will also work great in terms of boosting returns and minimizing underperformance risk.
Take that point. So there have to be some assumptions which have to be made, because it was a straightforward query with no goals written, no risk parameters also mentioned. So that needs to be kept in mind as well. Let's go across to our next query. Akash Pansari is writing to us from Jaipur, asks if it is better to invest in gold and silver ETFs or through fund of funds. Now, we are talking about it at a time when we saw the big rally come by in gold and silver. There was a time when silver ETFs were trading at a premium as well. Kirtan, first up, a good time to invest in any of these ETFs or fund of funds which have a commodity or a precious metal exposure? And if yes, which is the better way?
I think, Sonal, it's just a flip of coin, to be very honest, to be able to judge whether or not silver or gold will do any better from what they've already done. But I think as an investor, you should definitely stick to your asset allocation and not try and get into the FOMO because a couple of assets have moved in a certain way over the last 1 or 2 years. And I think that's precisely the biggest mistake that most investors make, right? Look at the last 1 or 2 year returns and then try and allocate money towards a particular scheme or a particular asset. But to answer Akash's question specifically, Akash has to understand the difference. The difference is very simple, that when you invest in an FOF, the FOF actually ends up buying the ETFs at the end of the day. But the major difference between both of them is that when you buy FOF, you get the day-end NAV. But in ETF, you actually have the liberty to be able to, kind of buy silver or gold while they are trading during the live markets. But like you rightly pointed out, lately we've seen how there have been a premium in the ETFs at which they've traded. So I think ETFs largely, in my opinion, is meant for more sophisticated investors who can do the intraday timing. They can also understand whether or not the price is at a premium than the fair value, which is the INAV. For a retail investor, I would still rather suggest him or her to actually stick with the fund of fund. It comes at a very small cost of 0.10 or 0.20 bips over the ETF, but I think it's a fair price to pay because you don't know how to calculate the premium, and whether or not if you end up paying a very high premium, which happened lately, silver prices were trading at 12-18% premium to the fair price. I think there's too much to pay for not knowing how to invest. So I think retail investors stick to FOF and professional investors can look at ETFs.
Okay, retail investors stick to FOF and professional can look at ETFs. Let's move on to the next query. Rushabh, this is coming from Anup, who's writing to us from Bangalore. He's asking if he has a timeline of 10 years to buy a house and his estimation of corpus that is required is going to be 5 crore rupees. He's asking if he goes full equity, can he fund his EMI using SWP mode? And after 10 years, he's also asking if 1 lakh rupees investment per month via SIP is something that would be sufficing him. How should he go about this whole process? Corpus that he requires is going to be 5 crores after 10 years.
Okay. So let's do the maths first, Avani. See, assuming 12% compounding returns in equity for the next 10 years, 1 lakh of SIP per month shall give him around 2 crores 32 lakhs. This is pre-tax. Okay. Now, out of 2 crores 32 lakhs, he can comfortably withdraw around close to 2 lakh of rupees via SWP route for the next 20 years. Again, these are all assumptions and pre-tax assumptions. That's very important. Okay. Now, depending on the loan tenure and the interest, this may be a little bit difficult, to fulfill, paying the down payment as well as, paying the EMIs. So this is what I would really recommend. Now to beat, because he needs to factor in inflation and taxation both. Now to beat inflation, taxation and the overall home loan, I think doing a 10% SIP top-up, annual 10% SIP top-up should do the job. If he does a 10% annual SIP top-up, I think it will be quite convenient in terms of taxation, in terms of beating inflation, as well as, beating the overall home loan as well.
Okay, that's very helpful, Rushabh. And these are the queries which we receive a lot of times, right? Because ultimately any investment is for a goal, and when it's very particular and precise, it really helps give that absolute answer as well. So let's go across to the next one, which is also for a particular goal. Madhu Mohan Babu is writing to us from Hyderabad. He says he wants to buy a house and he can invest 30,000 rupees a month through SIP. He asks which funds should he be looking at. I know there's no time horizon on when he would be looking at buying this house, but Kirtan, how should he go about it?
I think my advice or suggestion here would stay the same that we answered in the first question. Because look, again, the assumption here is that you have 8-10 years of investment horizon and you can take volatility. There is nothing much that you really want to do outside of 4-5 funds to build a portfolio put together. So I would still stick to the same funds that I suggested in the first question that came about, which was ICICI Value Discovery, PPFS, FlexiCap, Edelweiss Mid Cap and Nippon Small Cap. Now, there are 2-3 things that the investor has to understand here. You should actually only take up this portfolio provided you're okay with the volatility and you have some 8-10 years of investment horizon first. Second, you should try and split the 30K that you have largely equally amongst the 4 funds, because that will give you the balance across market cap and style of investing. And third, very importantly, let's say, for example, your goal is 10 years from today, right? Then at the 8th and a half year, all you have to then start doing is start moving a little amount of money from equity back to debt, because you don't want to be in a situation where you need money at the date of the goal and then the markets have not performed well in the near term and you are not able to redeem it because the markets are not doing well. So probably 12, 15, 18 months before you are supposed to hit your goal, start reallocating this money from equity back to debt so that the volatility on your portfolio reduces. And at the time of your goal, the volatility on the portfolio is very minimal so that you can use that money to fulfill the goal.
Okay, important, to start reallocating just before your goal and the time period comes in as well. That is also key to watch out for. But let's move on to the next query then. This is coming from Bala Subramanian, who's writing to us from Bangalore. He says that he has 43 stocks in his portfolio, 1 gold bond, 1 silver ETF, and of this total, he's saying 13 stocks are making a negative return. He's asking if it is prudent to invest in so many stocks at one time, or should he maybe invest in mutual funds for better returns? Rushabh?
See, number one, negative returns are part and parcel of the equity investing culture, right? 13 stocks is actually nothing, right? I mean, I'm glad that it's only 13 stocks which are negative out of the 43 compared to what markets we are in, which is, many of the indices and many companies are giving subdued 0 to negative return. So 13 stocks is actually just nothing. So number one, if he's investing in 43 stocks, then I think going via mutual fund route is something what I would really recommend, because on an average, well diversified mutual fund across different market capitalization would actually invest in anywhere between 30 to 70 stocks. Okay, so if he is, number one, able to time the entry and exit, because what happens in a stock is that you have to invest at the right time, and also the exit is also equally important when the price peaks out, which actually on the other hand the mutual fund manager beautifully manages and tries and times the stocks at the individual capacity. So I think going via mutual fund route, if he has 43 stocks, if he's not able to manage it, just stick with the traditional either a well diversified index fund or a well diversified active fund. This is something what I would recommend. But if he understands how to buy and sell stocks, then probably just keeping 15 to 20 stocks in his portfolio should do the job. 43 stock is a little bit on the higher side.
And that's a mutual fund in itself, right? 43 stocks in one portfolio. But we take that point. It's very helpful, Rushabh. But we'll slip into a short break. When we come back, we'll address more queries on the other side of the short break.
Welcome back, and you're still tuned into MF Corner. We still have with us Kirtan Shah as well as Rushabh Desai to answer all those queries that you all have sent us. Let's go on to the next query then, gentlemen. We have Reganta Nathan, who's writing to us from Chennai. He says that he has 600 units of Nippon Silver ETF purchased at an average price of 93.10. He's holding it for less than a year, and he's asking if he should buy more units of the fund. Rushabh, what's your view on this one?
When you see, number one, I wouldn't recommend buying additional gold or silver at this point of time. Specifically, he's just mentioned about silver. I really wouldn't recommend buying additional silver at this point of time, because silver prices have really gone way over the roof. And, even today, central bankers are buying, silver, and a lot of other institutional investors are buying silver left, right, and center. So I think, staying invested, for some more time. I'm understanding the investment is less than a year. So this is what I would recommend. Number one, don't buy additional silver. Number two, try and stay invested for a year. Once the one year is completed, if you are in profits, exit from silver as a product and book profits. I'll give you a very interesting data point, Vinny. See, when you are investing in silver from a returns point of view, it's very important to invest at a decent price and a time correction. See, over the past 15 to 20 years, I took out a very interesting data over the past 20 years. The last time silver had actually peaked out was somewhere in 2010, 2011. Okay. After that, it took 15 years for silver to peak out, which is today as we speak. So, the cycles, the cyclical cycles of silver is quite long. So I think investing at the right time and at the right price is something what I would recommend. Don't buy additional silver. but just wait for one more year because we don't know what the trajectory of silver would be in the next 3, 4, or 6 months or so. Once the 1 year is completed, then just completely get out of the product.
All right, so that's the suggestion coming in on the query that we just received. Let's go across to the next query. B. Govardhana Reddy is writing to us from Visakhapatnam. He says he has invested 35 lakh rupees in mutual funds, out of which 50% are core funds and 50% are in sectoral funds. He asks if it is advisable to allocate that 50% in sectoral funds. Kirtan, we have done like so many shows on how sectoral funds work and when one should look at sectoral funds. I don't think your view has changed, but what is your view on this one? 50% of the total corp is there.
Sonal, I think I'm just glad that somebody is asking this question again so that we can reiterate the same point and reach out to a larger set of investors. I think in my personal portfolio also, while I would like to believe that I understand things better than retail investor, I cap it at 20% because I think I am slightly better in a position to be able to time sectorial funds. What investors really have to understand is that they should not invest in sector funds unless they can not only get the entry but the exit correct. Because we've seen that looking at the last 2-3 years of performance history of a particular sector, investors end up investing in that sector and then that sector actually underperforms for a very long period of time, for 3 years, 5 years, and in some cases even 10 years to actually come back to the original price. So sector investing is for very sophisticated investor, and I would really suggest an investor not to keep more than 20%, even if that individual understands when to time the sector. And if you look at his portfolio that he shared with us, I would rather stick to only having, let's say, a pharma or a technology sector to be a part of his portfolio out of the sectors that he's mentioned. While we are positive on banks, but I would rather believe that in the core portfolio that he's invested, there will already be a lot of exposure to banks. So there is no need to have a financial or a BFSI sector fund to invest in because they'll add too much of concentration. And the other two sectors that he's mentioned, I would rather exit. So have 20%, even if you understand how to time the sector, have 20% outside of your core portfolio into sector. And from the current funds that he has, pharma and technology is something that he can hold.
Okay, pharma and technology is something that he can hold, but apart from that, you would not advise there. Rushabh, it's never enough to actually keep telling them about sectorial funds. What is your view as well, in the sectors that he's mentioned as well as his core portfolio? What would your suggestion be?
Vinny, I more or less agree with what Kirtan had to say. Taking sectorial bets is absolutely very risky. And capping it to around 10-20% is something what I would also recommend as well. So I think, you need to understand why are you entering in sectorial funds. Ultimately, you want to maximize on your returns, right? So if you want to maximize on your returns, I would strongly suggest just go for mid cap, small cap funds, or multi cap funds, which are more inclined towards mid and small cap. I think that should do your job. So I think rather than targeting individual sectors, just look at the broader index of mid cap and small cap. When there is a decent amount of price correction, valuation correction, just invest either in mid and small cap index funds or active funds. I think he'll be very well sorted. This is what my view is.
All right, take that point. Let's go across to the last query I think we have for the day. Kshitish Khandelwal writes to us from New Delhi, wants to know which mutual funds can be considered for children's future. Of course, it can be for education, higher education, and other purposes. Kirtan, let me start with you.
I think the first thing that I really want to address here is that they should not look at goal-based plans like the children mutual fund kind of funds available, because unfortunately, I'm not a great fan of these products because they have a 5-year lock-in, and at the same time, they are aggressive hybrid, which means they will have 65-70% in equity and 30-35% in debt. So if you're a long-term investor, it kind of, forcefully pushes you to invest in debt, whereas your investment can actually be on the equity side. But I think these plans solve a major problem. And that problem is that a lot of people invest in insurance because it is linked to a goal. I would rather suggest that rather than investing in insurance, this is far better. But outside of specific children-related goal plans in mutual fund, I think if you really want to build a portfolio, keep it very simple. Have a large cap, have a mid cap, have a small cap. You can replace the large cap with a flexi cap and mid cap with a multi cap, right? So you can have a portfolio which has 1 or 2 flexi cap funds, 1 or 2 mid cap, multi cap funds, and 1 small cap fund. I think that should be a great portfolio if you have an 8-10 year of investment horizon to invest.
Okay. And Rushabh, your view for Children's Mutual Fund, any suggestions there as well?
I agree with what Kirtan had to say, actually. I mean, the view is no different. I think, just keep one, 1 or 2 flexi cap funds or 1 or 2 multi cap funds. I think that should do the job. Just to add one more point is that, you can actually keep your child as a nominee. And once the child actually turns 18, you can gift the units via Demat account to your adult child when he or she turns 18. So I think going via the diversified active funds route or going into the pure mid and small cap route is something what I would recommend. And keeping the child as a nominee and gifting the units of the mutual fund when the child turns 18 via Demat account is something what I would recommend.
Yes, usually we talk about solution-oriented funds and go via those ways only. But as you both mentioned, it can be done in other ways. And as Rushabh mentioned, gifting is one of the options. This is something we also have to discuss because not a lot of people think or know about gifting of mutual fund units to another person. But it was a very insightful session, guys. Thank you so much for joining Kirtan and Rushabh and taking us so patiently through all the queries that we received. With that, we'll take your leave on this edition of MF Corner today. But stay tuned. We have closing bell to take you through the last hour of trade. We'll get you more updates on that one.